Welcome. Today is October 27th, Thursday. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and founder of Alpha Insights. And this is your Daily 5. Today, we are going to start with another shameless commercial on our free investment newsletter. And honestly, the reason that I mention this is just simply we get a ton of inquiries. I just want to make sure everybody's aware of it. We do publish an investment newsletter. It's free to subscribe. It's delivered directly to your email around the first Saturday of every month. So not this Saturday, but next Saturday, we got a new one coming out. It's affectionately titled Huge Insights, the Big Picture. And, therein we actually just discuss the key macro factors that we think are affecting the economy and the markets. And then we present our forecast, kind of like we do in this presentation. And so, we oftentimes get calls from subscribers, and they say, "Hey, we love your outlook and your views and everything, but how do we act on this? How do we invest? Actually, give us some ideas." And so, we've actually created an optional member level for those who want a little bit more. It's $10 a month to become a member. And what the membership actually does is it entitles you to receive our weekly Alpha Insights Idea Generator Lab publication, which details our top actionable trade idea each week. So if you care to take a look at this, you can find it on our website at jwhinvestment.com, or we're also on Twitter at alpha_insights. And with that, I'd like to jump right into chart number one. Chart number one looks at an interesting piece of cycle data. You may be familiar with the name Paul McCray Montgomery. Paul has, a history of being an incredibly insightful and talented market timer. Unfortunately, passed away back in 2014. But during his 50-year career on Wall Street, he developed some of the most innovative market timing barometers that are widely used today, including the magazine indicator, which many people focus on. So, we've actually been discussing a couple, really the potential significance of a couple of cycle turn dates that come from Paul's work. The first was Tuesday, October 25th, and the next is November 8th, which is actually election day. I think the whole question about cycles is really difficult to approach from a lot of different perspectives. The consistent accuracy of the lunar and planetary cycle model that Paul developed has really confounded many people in the business, who have historically regarded this as nothing more than just pure luck or astrology, a pseudoscience at best. But Paul actually developed several Fibonacci time spirals, and he used those to identify key dates in this lunar cycle predominantly, where we looked at full moons and new moons and in fact, eclipses and things of that nature. And in fact, the first date that we threw out was October 25th. There was a new moon and a lunar eclipse, or solar eclipse rather, at about 7:24 p.m. Eastern on Tuesday night. So, it kind of bracketed the 25th and the 26th as key cycle turn dates based on Paul's time spiral, which was a Fibonacci 34 days from the autumnal equinox. And so, we had a variety of things come in. He called this a major cycle turn date. Now, what we've done is we've actually gone through and we looked at the cycle turn dates that his work has identified throughout the year. And the major cycle turn dates are illustrated in red, the minors in blue. And so beginning at the beginning of the year, we had a major cycle turn date almost at the exact peak of the market and several more mid-year. And now we're seeing another two sequential major cycle turn dates. And what I think might possibly be the case is that, we've seen the NASDAQ 100 top on Tuesday ahead of the cycle turn. We saw the S&P 500 top yesterday following the cycle turn. And the Dow actually made a new high today, which shows a fracturing between those three major indexes. If the Dow tops today and rolls over, then I think that will probably confirm that the cycle was a top, and that the next cycle we need to be aware of is the February 8th cycle, which could potentially be a bottom. So with that, let's take a look at some additional evidence in chart number 2 that supports the notion that the market may be topping as we speak. This is a chart of the ARMS index. This is also known as the short-term trading index or the TRIN. And, it was developed by a fellow by the name of Dick Arms back in 1967. So it's got a long history. And, what it suggests is that, while equity markets were deeply oversold at quarter's end, today, equity markets are massively overbought by this measure. What you could see is that the trend is actually calculated by dividing the advanced decline ratio by the advanced decline volume ratio. So what you're really looking at is like a volume adjusted breadth indicator. And typically, because of the way it's calculated, strong advances are usually accompanied by low readings and vice versa. And that's because even if breadth is expanding, if volume is very, very strong, it's the denominator that will actually create a lower outcome. So a lower number means overbought, a higher number means oversold. And what we've done is we've smoothed the data using a 10-day moving average, which gives you kind of the last 10 days of that reading. So it's a lot less volatile and more meaningful in order to create a reliable overbought, oversold indicator. And so what we see today is that the indicator is now more overbought than at any other point in the last 2 years, including the market's all-time record high. So we just made a new record low for the past roughly two years or so. And given that, it suggests that markets really are no longer overbought and must be considered, or no longer oversold, must be considered overbought at this point. Let's take a look at sentiment in chart number 3 to get a sense of where investors' attitudes are. The question that we pose is, everyone is bearish? Fear is what has been missing from this entire bear market decline off the January high, if you ask us. For all of the hand-wringing over record put buying by retail and institutional investors, we're looking at put-call ratios for both index and equity options. And it's clear from this data series, which dates back to 2004, that the put call ratios never reached the extremes that we witnessed at past bear market lows. We've heard some on the street making statements of this effect: everyone is bearish, everyone can't be right. But for some reason, we never hear those puns when the market's strong and everybody's bullish. It should work both ways, but for whatever reason, people tend to focus on the bearish side of sentiment. And it's really difficult to suggest that investors are bearish at this point. In fact, I'd go as far as to say that investor sentiment's no longer bearish at all. And in fact, if we're basing this on option trader positioning, at very worst, it's neutral. And it looks like it may be trying to turn bullish at this point. So we no longer believe that the market is oversold. We don't believe that sentiment is overtly bearish. And we've got a cycle turn date that suggests that the market probably is topping right now. And these conditions support that. So let's take a look at the market itself from a charting perspective, right? And so I'd like to look at it first from a short-term perspective and suggest to you that from a short-term perspective, we see this as a counter-trend advance, and it's really just a matter of degree of trend. We've proposed two high-probability short-term Elliott Wave counts here, alternate 1 and alternate 2. Both assume that primary wave 2 topped on August 16th. Now, alternate 1 on the left-hand side of the screen considers the possibility that intermediate wave 1 of primary wave 3 down bottomed in early September, and that intermediate wave 3, which is the decline that has begun off of the September 12th high, which was intermediate wave 2, is now subdividing as minor wave 1, 2, 3, 4, 5. And so far, we can only count wave 1 and 2. So we're looking at a wave 3 decline to follow here very shortly. Alternate 2 considers the entire decline off the August 16th high as being primary wave, which was primary wave 2 high, to be intermediate wave 1 down. So we're looking at this entire decline from August 16th to October 13th as being intermediate wave 1. And we have a 3-wave, counter trend corrective waveform, WXY, that's retraced about 50% of that decline as of yesterday's high. We believe that counts best as intermediate wave 2 under this rubric. And if so, we are now on the precipice of a decline at a 3rd wave degree. So, in either case, regardless of which of these 2 labelings is correct, it really doesn't matter because the next sequence in the wave count is to the downside. So let's take a look at chart number 5 to see where that materializes. If we are correct in our count, and this is our preferred long-term Elliott Wave count, looking back 13 years on a monthly view from the right-hand side of this chart, and on the left-hand side, a more focused 3-year weekly view that just kind of blows up that final rally off the March 2020 lows. Basically, I'll explain it this way. Our preferred count assumes that the January high was the end of cycle wave 5, and by extension, the end of super cycle wave 3. Now, if that is correct, then a 4th wave correction at super cycle degree is now operative. And under this whole rubric, the June low counts best as primary wave 1 down of cycle wave A down. And the counter trend advance that ended on August 16th counts best as primary wave 2 up of cycle wave A down. And as such, primary wave 3 down of cycle wave A down is now underway. Now, by our best count, primary wave 3 is subdividing into 2 lower degrees of trend as we outlined in alternate number 1 in the prior slide. And so if that's in force, what we are looking at, if the market topped on October 25th and 26th, last couple of days, as we're suggesting from a cycle perspective, then we are now at the precipice of a 3rd wave decline at 3 degrees of trend. That should be a powerful decline and could carry the S&P 500 down as low as 2750 to 2400 to complete primary wave 3 down before we get any sort of a reprieve from selling pressure or a meaningful counter trend bounce. Now, looking on the right-hand side of this chart, the 13-year monthly view, we would expect a 4th wave counter trend advance to follow, and that should be followed by a 5th wave plunge to new lows, which we estimate in the area of S&P 2250, which marks a prior 4th wave extreme, the 61.8% retracement of the 13-year advance off the 2009 low, and also the 200-month simple moving average. Now, if that's correct, then that should terminate cycle wave A down, and that will be followed by a counter trend advance, which should be cycle wave B up, and that will precede the final decline, which will be cycle wave C to the downside to complete counter trend wave 4. And so the view is not optimistic, put it that way. We're looking for significant downside to precede a more meaningful advance that should come around mid-year next year. That's the view. And at this point, we are advising clients to raise cash into this bounce and to minimize equity exposure. With that, I want to thank you for watching today and invite you to reach out if you've got questions. You can get a hold of me on my website at jwhinvestment.com or follow us on Twitter at alpha_insights. I am live every Tuesday at 9 a.m. Eastern on OETV. I'm also on LinkedIn, or just feel free to shoot me an email if you like, jhuge@jwhinvestment.com. Again, thanks for watching.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.